If you have a TFSA in Canada, you're most likely making one of these 5 mistakes, which can be extremely costly. So you want to watch this video and pay attention. If you like the content, make sure you click subscribe. If you're watching this on YouTube, there is a visual with it, as you can see. And please leave a comment as well. Give it a like. My goal is to reach 500 subscribers because it's going to mean that every time that I post a video, I'm helping 500 people at a time, which would be an amazing short-term goal. Now, if you're listening to this on Spotify or Apple Podcasts, you can also rate it at the top and leave a comment. That really helps with the algorithm and rating this podcast as well. So let's dive into the 5 costly mistakes that you might be making with your TFSA. Now, even though I specialize in servicing business owners, this definitely applies to people who even don't have a business. Everyone is making these mistakes, and I see it all the time when I meet new clients during the intro meeting, and even working with current clients. My goal is to help them really make the best use of a simple account like the TFSA. So let's dive into it. The first mistake that I see people making, the most common, is actually not using your TFSA at all. And especially if you have a corporation, you might think that you're better off to leave the money in your corporation and not use your TFSA, because when you're paying money out to yourself, you're paying taxes. But if you understand the concept of integration, dollar earned in your corporation should equals to the same dollar earned personally. So all in all, it's almost a washout. And then once that money is paid to you personally, it should be invested in a TFSA if you have the room. Long story short, definitely use your TFSA. And if you were 18 and older at the time that it was created, the TFSA was created in 2009. That means you have $109,000 of available room today, and then $7,000 every single year in addition to that. Now that's $109,000 that you don't pay taxes on dividends, interest, or capital gains that you're realizing, or withdrawals that you're realizing within your TFSA. And then when you make your withdrawal, you get the room back the next year, which I'll cover in a second. But again, make sure you use your TFSA and you don't leave money in your corporate account, because in your corporate account, you're exposed every time that you're receiving a dividend or interest from a fixed income coupon, you're being taxed on that, or a GIC, you're being taxed at the highest rate. Yes, you can recapture some of that tax through the RDTOH accounts, but you are still better off to pay that out to yourself and maximize your TFSA. Now, let's look at a little comparison between just a TFSA and a taxable account. If you look at $109,000 today that you will invest for 25 years, and you will contribute annually $7,000. Expected rate of return, net of fees and advisor fee, is 7.5%. In 25 years' time, you can expect to have accumulated $1.2 million versus a taxable account where you would have about $6,000. So that's a $214,000 lost in taxes. In this example, I'm assuming that you actually have no dividends or interest income. You're purely invested in capital gains, and they are realized at the time horizon, so at the end. But this is just a simple example to show you that sheltering investments from taxes is extremely beneficial. This is a very conservative calculation, because if you had a portfolio that was not only subject to capital gains, but also interest income, dividend income, and then you were with a portfolio manager who's doing a lot of training intra-year and in and out, you would be exposed to a lot more taxes, and your ending balance at the end of time horizon, whether it's 25 years or any other time horizon, actually your ending wealth would be actually a lot lower. So that's another thing to consider, and of course, to favor your TFSA. The second mistake I see that is the most common is not using your TFSA for long-term growth. This is very interesting to me because, of course, the name tax-free savings account might make you want to put your money into safe investments. It's not really a saving account. It's not a saving account at all. It's a retirement account. And if you are someone who is saving for retirement, you should invest in a way that's going to help you amplify and grow your wealth over time for retirement, whenever that may be. Might be in 5 years, might be in 25 years. But the problem is, if you're putting money into a TFSA, $80, $90, $100,000, and you just park it into 2-3%, that can be extremely costly over decades. For example, let's look at the calculator again. The difference between growing a portfolio at 7.5% for 25 years, you would get $1.2 million. But for example, let's say you park it in a GIC, which I see all the time. People don't know what to do with their money. They're going to put it into a GIC. And let's assume you're earning about 3%. That balance over that same time period will be less than half. So just shy of $500,000. That's $500,000 lost in growth opportunities over that time period that you could have captured just by being invested properly. And that's what we mean by investing, making your money work for you and investing it and aligning your money with the required goals. Retirement is one of them. Kids' education, saving for a home or a bigger home, investing for just future lifestyle goals. Whatever goals you may have, that's why it's so important to have the right portfolio aligned with the right goal. And this is exactly how you avoid losing about $500,000 by making one of the greatest investment mistake, that is leaving money on the table, especially when you have a long time horizon to compound it. And I'm assuming here that you have the right risk tolerance and the risk capacity to take that risk. And that's why having a financial plan is really key before even investing, before even choosing which accounts to invest in and how to invest. You need to have a financial plan. If you want one or you want to inquire how I work with clients, you can use the link below to book an intro call and I can walk you through how it works to start with a plan. But the takeaway from the second mistake is that the TFSA is for long-term growth, is not a saving account. And you already have your corporate investment account, your holding company, your taxable portfolio, but the TFSA is often the best place to grow your asset long-term, again, because of its tax-free nature. Mistake number 3 that I see the most often is actually split in 2 parts, but it has to do with trading inside your TFSA. Now, there are 2 problems with that. Problem number 1 is that you might be subject to being charged active business income or taxes on active business income by the CRA if they identify you as someone who is buying and selling stock constantly. So it's no longer going to be tax-free. That's the first problem. And why is that a problem? Is that now you lose the benefit of the account in the first place, because now it becomes a taxable account based on the activity that you're doing in your account. Now, that doesn't mean you shouldn't be trading in your TFSA necessarily. Well, that's exactly what it means. You shouldn't be short-term trading in your TFSA. We don't recommend you to short-term trade anyway. But if that's something you want to do, you might want to think of maybe doing it in a non-reg account, given that you might be subject to active business income. Now, the second problem in the same mistake number 3 of trading into your TFSA that I see most often is making extremely speculative bet inside your TFSA. Hear me out. The TFSA, whenever you make gains, yes, they're tax-free. But if you're wrong, and I'm telling you, at some point, if you're an active trader, and I've been in the industry for over 10 years, I can walk you through my experience in a subsequent video, but at some point you will get losses, and not all your gambling bets or your speculative bets on single stocks will turn out to be okay. So if you have a loss in a TFSA, you cannot use it to offset your gains. If your loss was in a non-registered account, you could use it to offset your gains that are also from a non-reg account. But if it's trapped into a TFSA, you lost that ability. So my recommendation to you and any of my clients that are trading or they're trying to time, now it's the oil market, commodities market, futures market, or the S&P, any indices that you might want to try to play, or as single stocks or penny stocks that you're trying to gamble in because you think it's going to double or triple. If you do it, try to do it in a non-reg account, because your risk to reward ratio, the risk of your trade going sour, is a lot higher than you think. So the other way to say it is, if you're investing in a low-cost diversified index fund, things like VQT, XEQT, FEQT, then you definitely won't have this in your TFSA, because the likelihood of this going down over time permanently is almost zero. Like, at some point, you have a much, much higher probability of compounding and making money over time than on a penny stock. So the riskier your investment is, the more I would put it into a non-reg account, and the safer, the more predictive the outcome is of your investments, then I would keep it in your TFSA. So that was mistake number 3. Trading in your TFSA and making speculative bet that can turn into massive losses in your TFSA that you can't use to offset your potential gains, essentially. Now, mistake number 4 is not planning your withdrawals strategically from your TFSA. And this is true when you're accumulating money, but it's also especially true when you're retirement. For example, when you make a TFSA withdrawal within a given year, if you need money to buy a home, a business opportunity, something that's getting married, whatever reason you need to take money out of your TFSA, you will get your room back the next year. So if you have $109,000, let's say you had no growth in your TFSA, or $100,000 to make it easy this year, and you need to take it out starting January 1st, 2027, you will get $100,000 back in your room, which you can put money back into your TFSA. Just making sure that if you're planning, you need to plan ahead and make sure you take it out in advance so that you can get your room back for the following year. Even though you might only need the money, for example, in 2027, then I would want to take it out like before the end of 2026 so that you have it for 2027 and then you actually get your room back that year. But those are the small efficiencies that working with a planner can help you capture every single day, which can ultimately compound to meaningful wealth down the road. Now, the other thing too you need to make sure is you need to make sure that when you recontribute, you have the room available back. So you cannot recontribute within the same year. And this is really key. Part of the same mistake, number 4, is not planning withdrawals properly in retirement. A lot of retirees are thinking that because it's tax-free, they should actually use it earlier than later in retirement and postpone their RSPs and their other accounts to later on because they want to avoid paying taxes. But the biggest thing, which I'll cover in a separate video, is that that's actually pushing you a massive tax bomb down the road. Because now if you retire, let's say around the 60, and you're pushing your RSP or RIF withdrawals, for example, all the way to 71, then by the time you'll have mandatory withdrawals, you might be in a much higher tax bracket than necessary than if you plan ahead. Now, there's a lot of strategies that we can go into around RSP meltdown and withdrawing your RSP early. But this is really key, is not necessarily using your TFSA because you think it's tax-free early on. And that your strategy might be better off to actually keep it for as long as possible and not touch it because of its tax-free nature, and then start using your taxable account earlier on while you're managing your tax bracket, from early retirement to midway through retirement to all the way to the end of retirement. So not only when you're accumulating, but when you're also in retirement, it's really important to manage your withdrawals from your TFSA strategically so that you can minimize your taxes over your lifetime, not in a single year. That's the key. Now, mistake number 5 and last mistake is naming a beneficiary instead of a successor holder. And I will caveat this by saying that there's a lot of content on this on social media. And I think they're all clickbaits. Let me explain. Yes, they're right at putting this content that you should be naming a successor holder on your TFSA instead of a beneficiary. I'll explain you why. But you can also rectify this if you haven't done it. And that's why a lot of people are actually not mentioning. So let's go through an example. So many people will put their spouse as beneficiary under the TFSA, the same way they would put their spouse as a beneficiary on their RSP and other accounts. Now, why is that a problem? Well, whenever that person dies, the surviving spouse, instead of receiving the TFSA account, they're going to be receiving the value of the TFSA. So if the TFSA was $500,000 at that point in time, or $200,000, whatever they may be, then they will receive $200,000, the value of the TFSA, tax-free. Now, you might say, well, Guillaume, why is that a problem? Well, here's the thing. That person, when they receive that $200,000, if they don't have room in their TFSA, they have to put it in a non-reg account. Now, in a non-registered account, is taxable. So that's why putting them as a beneficiary is not as beneficial tax-wise. So what's the solution? You want to put them as a successor holder. When you put your spouse as a successor holder, when you pass away, your spouse is now inheriting your account. They can roll your account into their account as well. They don't need to have the room. That's what successor holder is. So they're inheriting the entire account with the benefits as well. And that can be extremely beneficial if your spouse still has 10, 20, or 30 years to go and they want to have that money invested tax-free again. So that's, again, small things that can really add up over your lifetime. But now you might be asking, okay, but what if I forgot to put them as a successor holder instead of beneficiary? What happens in this case? Well, you can rectify this by filing a Form RC-240 by the end of calendar year that follows the year of death. And the choice is only available for surviving spouse or common law partner. So again, this is something that, yes, you should be doing in advance, but if you forget, there's always a possibility to rectify this. Now, to wrap up this episode about the 5 biggest mistakes that I see people making with their TFSA is that the TFSA is one of the most powerful wealth building tool that is available to Canadians. But many of the strategies inside your TFSA depends on how you use it. So in order to be effective, you need to be using it the right way. And if you're doing actions that are contrary to the benefits of the TFSA, then you're hurting yourself. And that's where you're losing potentially $500,000 or more throughout your lifetime by misusing the account. If you're a business owner and you want to see your financial readiness score, there's a link below. It takes less than 3 minutes and it can tell you where are the gaps, the hidden gaps in your financial plan that might be costing you tens of thousands of dollars. Use the link below to get your score and then see what actions you need to take in order to make every dollar work for you and build wealth more efficiently. Thank you for listening, and we'll see you in the next episode.